moving on to the large companies, they employ lots of labor, they have a lot of supply chains, they are crucial aspect of our economy. Now, if they go under, that has a huge impact as well. Unlike small and medium companies, a large company going under will have a bigger impact, of course. Now, should there be two different strategies? You get an excellent strategy for small and medium and SIDBI getting involved, and maybe the government taking on some of the incremental loss with loans. Should there be a different strategy for large companies?
Well, yes, part of a related strategy. I would emphasize that in emerging markets, if you want to save on resources, you have to look at first the viable parts of the corporate sector to help, and the most viable, will be the large companies that are well established, that employ a lot of workers, and we have to make sure that none of them go under in this period to the extent that it can be done with modest resources. So, for example, some of them are finding it difficult to raise funds in the corporate debt market, and some of them find that bankers don't want to lend more. So perhaps a attempt to prop up the market for corporate bonds, that is something the RBI could help in. For example, by lending to financial institutions like insurance companies, well-managed NBFCs, as well as the banks, and encouraging them to use those loans to invest in corporate bonds so that large firms have a new source of access to funds. And the nice thing about that is large firms are often part of large supply chains where they have a lot of small firms supplying to them. Think of Maruti, for example. And if Maruti infuses more funds into its small suppliers, and it has an incentive to do that to keep its supply chain alive and well, then that's a way of infusing funds to small producers, something that banks may find great difficulty in doing. So we need to activate every channel through which liquidity can go through entities that have a way of pushing it further into the small and medium sector. So using the large sector, including firms, but also financial firms, to push liquidity into the small sector may be the way to go at this point. And the Reserve Bank can be a way of pushing that liquidity into those sectors.
So what you seem to be saying is that the Reserve Bank of India, the lender of last resort in our country, has got a very important role to play over the next few months, maybe a year, even more. Does that mean that the Reserve Bank of India has to change its way of functioning a little bit, try new methods to take on this crisis, and to think out of the box, and to, of course, stay prudent, but experiment with new ideas? What should the RBI be doing along with the banks and, as you said, insurance companies and NBFCs?
What I'm advocating is two things. One, that the RBI open the window wider for the kind of collateral it will accept, including, for example, investment-grade corporate bonds. That will allow them to refinance many of these banks against some of the assets that they have, which earlier they could not borrow against from the RBI. So that could pump more liquidity into our existing banks. But the second thing I'm suggesting is that they also lend to entities they normally don't lend to, such as well-managed NBFCs, as well as insurance companies, and see if those entities cannot expand their assets by buying more corporate bonds. That will push more liquidity into the system. And of course, NBFCs can make direct loans also, as they've been doing. Again, it does imply that the RBI will be doing something different, something new. It has to manage the credit risk, for example, by taking haircuts in the portfolios that it accepts as collateral. But it is doable, and it is something that would infuse more liquidity into the system, which it desperately needs at this point.